Well, joining us now with his reaction to the jobs report is former Fed Vice Chairman Alan Blinder. He is now a professor of economics at Princeton University. Welcome, Alan.
Good to be here.
Well, do you agree with consensus that this is a good report and that it is a strong signal the recession's over and we're in the early stages of recovery?
Well, I wouldn't quite go that far. You want to remember that we lost 250,000 jobs in a month. A few years ago, we would have thought of that as horrendous. But compared to the unspeakably bad jobs reports that we've gotten used to over the last year, this one is definitely a tick upward. I think in terms of GDP, we've seen the worst already. That is to say, the third quarter is going to be up and could be up strongly. In terms of employment, we're still going downhill, but downhill at a slower rate, and that's important. You don't turn up until you start going down at a slower rate, and it does appear pretty clearly that we're doing that.
All right, so given the fact, though, that inventories are low, capacity utilization is at a record low, there's got to be room for employers to add workers here. So will that perhaps be an improvement to the labor market?
Oh, absolutely. I mean, the next step that we're looking for is for these job losses to dwindle to negligible levels and then turn positive. You know, we've fallen into a deep hole. It's nice to see the unemployment rate tick up 0.1%, but it's still around 9.5%. And most people would put the full employment unemployment rate, or the so-called NAIRU, closer to 5%. So we are a country mile away from where we should be.
Well, Alan, what about the recession end, though? I keep trying to remind people that recession end means you hit an inflection point in the economy.
Right.
Once you're at the bottom, there's only one way to go, and that's off the bottom.
Right.
The recession ends.
Right.
Were you in the camp that say the recession ended in June? Is it ending now?
Yeah, well, I'm not ready to pinpoint the month, but yeah, I think the history will be written that the recession ended in the summer of 2009. Exactly what month, who knows? You know, data get revised. For example, we just learned that the recession was deeper than we thought it was. But again, I want to emphasize, in terms of GDP, I think we're past the bottom, and the third quarter is going to be up, and maybe up strongly. In terms of employment, we're still sliding downhill.
Still, Alan, interest rates shot up, especially hearing the number of the July jobs report. The payrolls lost much fewer, of course, than anticipated. What does this mean for the Fed, in your view? Can the Fed change course now?
No. The Fed is certainly going to maintain, I'm sure, at its next meeting, this extended period language, indicating that it's not about to raise interest rates. It's also not about to end its various quantitative easing policies, except a few of them that aren't even used anymore. They're not suffering from overconfidence about the strength of the economy, but I do think they must be upgrading their forecast. The forecast that they gave the last time, the last published Fed forecast, was way too pessimistic relative to what's happening.
Okay, Alan Blinder, if you'd be so kind to wait with us through our commercial break, we will return to our discussion. And welcome back, everyone. If you are just joining us, we've been discussing the monthly jobs report with former Fed Vice Chairman Alan Blinder. He's also professor of economics at Princeton University. And, Alan, we were talking about whether or not this jump in interest rates on the back of the jobs report today meant the Fed could change course. You said no. So now I'm curious if you have concerns about rising inflation now.
Certainly not in the near term. In fact, I don't have concerns even in the broader over 5-10-year period. One would have concerns if you thought the Fed was incompetent and not going to do its job well. I don't believe that. But even if they were incompetent, for the near term, we have so much slack in the economy. Wages are going up so slowly, as you mentioned earlier. Inflationary expectations are on the floor, as you can read out of the TIPS market. There's just no inflation in sight and no prospect for it anytime soon.
Alan, you just said that in the previous part of our interview that the Fed was way too pessimistic in its forecasts. Now, if the Fed was way too pessimistic and the Fed has been giving these signals of look, extended period, keep rates low, and the economy snaps back faster, does that start to change their view or your view about the near-term inflation threat? There are people out there saying the Fed's not going to raise rates till 2011. A lot of people disagree, but some high-profile calls like that.
Well, first of all, I've never been in that camp. I've been saying for a long time that I expect the first rate hike to come in the first half of 2010, never mind 2011. My forecast hasn't changed. I've been much more optimistic than the Fed. I think what it means for the Fed is as they think, but not as they speak, about what extended period might mean. That's a deliberately vague phrase only intended to indicate it's not in the near-term horizon. But as they think among themselves how extended this period ought to be, that's probably shortening. I think it is.
So a little more close to home, next week, both Lyle Gramley, former Fed governor, Larry Meyer, former Fed governor, quoted saying the Fed will announce that it's not going to buy any more government bonds. Do you think they will, number one? Do you think they should stop buying bonds, number two?
Well, on the second question, I never thought they should have bought them in the first place. I never thought, of all the Fed's programs, that's about the only one that I've been very critical about. I don't really understand the purpose of it very well, since the whole issue was getting down the spreads between treasuries and other securities that follow some risk. On the first question, I don't see why they would want to make any announcement. There's a difference between doing what Lyle and Larry said, that is, not going any further than the already announced $300 billion, and maybe not even reaching that, depending on how things turn out. There's a big difference between that and actually then making a pronouncement that you're not going to do so, because that sort of locks you in. And while things are looking better now, maybe they take a turn for the worse, and Bernanke and his friends decide they want to buy more. I think they want to leave themselves that flexibility.
Okay, our thanks to Alan Blinder, former Federal Reserve Vice Chairman.
Welcome.
And Kathleen Hayes, thank you as well to you.